Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 1, Forecasting Financial Statements and Free Cash Flows. A good reference for this material is Benninga's Principles in Finance with Excel, Chapter 7, Chapters 1. In this topic, we're going to design financial modeling using appropriate styles and organization, forecast an income statement and balance sheet, compute free cash flows, and perform financial statement analysis. Let's start off by building our first financial model. And all we're going to do is forecast EBITDA for our firm. So EBITDA, earnings before interest, taxes, depreciation, and amortization, is a measure of performance before financing, taxes, accounting, and investment decisions. And we're going to take an example from the textbook in Chapter 7, Whimsical Toenails. They had sales of $10 million last year, and OPEX, or operational expenditures, of $5 million, which were 50% of sales. So 50% of their sales were costs of goods sold and G&A. So the question is, what is their EBITDA if you make these two assumptions? Sales grow by 10% and OPEX as a percent of sales remains at 50%. So let's build a financial model using Excel modeling best practices. So I'm going to switch over to Excel, and let's go ahead and build the financial statement that was given. We had sales of 10 million. So I'm going to put in 10, 1, 2, 3. And I'm going to change that to a dollar sign and get rid of 2 decimal places. So there's my sale of 10 million. I had OPEX of 5 million. Which gave me EBITDA of B5 minus B6. And you can always start off a formula with either a plus or an equal sign if you're just starting with B5 and subtracting B6. So these are my actual results from last year. I'll go ahead and center that. And what I also want to do here is put in some cell styles. So I'm going to highlight these 2 numbers here where I put in values. Now generally anytime I put values in Excel, I'm going to go to Home, Cell Style, Data and Model, Input. That tells any user that these are values, these are numbers, these are places you can change cells, not formulas. And on the last one here, I'm going to put in a cell style of calculation. Now cell styles are not required, but it's good best practices to add these cell styles. So when you look at this spreadsheet in the future, or other people look at your spreadsheet, they can see that these are the values, these are the calculations. Now I'll just put a grid around that. So I'm going to highlight this whole area, select the borders, and put all borders. All right, now I'm going to insert a little row here. So I'm going to insert, and I'm going to put in my value drivers. So it's best practices to have all your value drivers, the things that drive the future results, up top. So that's going to be sales growth, and that's going to be OPEX percent of sales. I'm going to widen that column a little bit. So my sales growth is 10% and my OPEX as a percent of sales, whoops, wrong place, 10% and OPEX as percentage of sales of 50%. I'm going to make those inputs and go ahead and add a grid. And now I'm going to forecast next year. I'm going to copy this over by dragging. I'm going to change this to forecast and change all these to calculation. And the only reason I dragged it is really just to get those dollar signs over because it copies the formats. And I'll delete this. So my forecast next year are sales times 1 plus. Now what you never want to do is put in a number like 0.1. Never combine a formula with a number. You want to have referenced this cell right here. And by the way, we should have made these inputs. So my forecast for next year are sales of 11 million. OPEX is going to be sales times OPEX percent of sales. And then we'll add the EBITDA calculation of sales minus OPEX. And sometimes in a spreadsheet, if I want to highlight the result I'm looking for, the actual point of the whole spreadsheet is to calculate this EBITDA number, I might just give it a cell style and give it one of these accents. So there's my first financial model. So here's what we've created, a financial model that has value drivers up top. I did not combine any numbers and formulas. That's the best practices number 2 or number 3. I used labels, sales, historical, forecast, OPEX, percent of sales, and so forth. And I used Excel's default styles. So now what we're going to do is take an example that I modified from the textbook of this whimsical corporation that had sales last year of $2.246 million. There it is. And then we have all these actual results. So we'll call it year 0. All that means is these are results last year. We'll pretend that the year ended last year and these are the financial results. And what you see is you have sales of 10 million. That's what we call that the top line. So your top line is 10 million. Your cost of goods sold and G&A, in other words, your OPEX is 5 million, which gave me 5 million of EBITDA. Had depreciation expense of $1 million, right? Depreciation is the recording of historical capital expenditures, the expense from those. Then we have the EBIT, in other words, operational profit. EBIT, earnings before interest and tax. In other words, it just includes the depreciation of 4 million. We're going to subtract off debt interest or loan interest. We're going to add back any interest they earned on any of the securities they own, say short-term treasuries or other cash-like securities. And that's going to give us our earnings before tax of 3.7 million. We have taxes here, which turned out to be 40%, is based on the earnings before tax. And then that leaves our EBIT, or I'm sorry, our net income, or earnings after tax of $2.246 million. The corporation paid 40% of that out as a dividend, and the rest went as retained earnings, in addition to retained earnings. As far as the balance sheet goes, they had cash and cash equivalents. That's what's driving the interest up here. We'll assume all that is interest bearing. They had accounts receivable and inventory of 1.5 million, what happens to be 15% of sales. So we're going to use that as a value driver to forecast the future. They had fixed assets at cost, so the historical recording of all capital expenditures at cost of 10.7 million. They've accumulated depreciation of 3 million so far, so those assets are sitting on at a book value of $7.7 million. We have total assets then of $10 million, which are our net fixed assets, cash, and accounts receivable and inventory. We have accounts payable, which are 8% of sales. We have our debt of 3.2 million, which is driving our debt interest expense. That gives us our total liabilities. Then there is stock. That is the value of the shares issued. We have the accumulated retained earnings, which is the recorded history of all the net income that has not been paid as a dividend. That gives us total equity, total liabilities and equity, and there's our fundamental equation, equality in finance. Our total assets are equal to liabilities and equity. In other words, all the assets that you hold had to be financed somewhere, and you finance it by either issuing stock, using retained earnings, issuing debt, or getting financing from, say, accounts payable. There are 10 million shares outstanding, and that's the results from last year. Now here's what we're going to do. As a financial analyst or financial manager of this corporation, you've been asked to forecast what the results will be next year given these value drivers. 1, sales grow by 10%. 2, in order to get sales to grow by 10%, they're going to expand their assets. So they're going to have capital expenditures. In other words, that's going to be new fixed assets at cost of 1.668 million. And those are going to be depreciated over 10 years, so we're only going to see 10% of that expense hit the depreciation this year. Now here's a big assumption. All other income statement and balance sheet relationships hold. In other words, sales or receivables are a percentage of sales, payables a percentage of sales, OPEX is a percentage of sales, interest on debt, interest on cash, tax rate, all that's going to stay the same. Dividend payout is going to stay the same. And for the first pass, in other words, for the first time we do our forecast, we're going to have no change in cash, no change in debt, and no change in stock. We're not going to issue or buy back any more stock. We're not going to issue or pay off any debt, and we're not going to have a change in cash. So those are going to be driven by these 3 value drivers. Later we'll play with those and maybe increase or decrease debt or equity or cash. So let's go ahead and build our pro forma financial statement. Pro forma means our future forward-looking financial statement. So let's switch over to the start file. The start file that was pasted in the website. And I'm going to go to the First Pass tab. And here's what we just looked at. So let's go ahead and build our financial statements. Sales, year one, are going to be historical sales times 1 plus sales growth. $11 million. OPEX is going to be a percentage of sales. So I'll take my sales forecast in year one times my OPEX as a percentage of sales. That gives me EBITDA of 5.5 million. We already did that. Now depreciation expense. We're going to take the change in accumulated depreciation from the balance sheet. So we'll get down to there in a few minutes, but let's take the accumulated depreciation forecast for year one minus last year's. So that change in accumulated depreciation must be the expense this year. Now, where did this number come from? Well, last year was $1 million expense. So if we are continuing to depreciate our assets at the same rate, you would expect it to be $1 million this year. However, we purchased $1.6 million of CapEx. It's going to be depreciated over 10 years, so 10% of 1.6 million, 160,000, that's what's going to be added to last year's, and that's all done in this calculation here. That the accumulated depreciation in year one is last year's, plus the $1 million expense last year, plus the 10% or 1/10 of the CapEx this year. All right, let's get back to the income statement. My interest on debt. We're going to take the interest rate on our loans of 10%, which is a value driver, times the average debt balance. So I'll just use the average function, average, open paren, and let's grab the two debt balances, year 0, comma, year 1. We're going to do the same type of thing for cash. I'm going to take my interest earned on cash or cash equivalents, short-term interest-bearing securities. So I'll take my 8% times the average of my cash balance. Taxes are going to be earnings before tax times the tax rate. We'll assume that stays steady at 40%. Whoops, wrong 40%. That should be this 40% right here, the tax rate. Make sure you change that. We're going to have dividends. Historically, they paid 40% dividend payout rate times the net income. Looks like I made a mistake there. Let's try that again. Dividends are going to be net income times 40%. Which gives me additions to retained earnings, my net income, or my earnings after tax, minus the dividends is what is added to retained earnings in the balance sheet. So that's the connection between the income statement and balance sheet. That 1.46 million is added to accumulated depreciation right here. So let's go do the rest of the balance sheet. Let's assume no change in cash. So you see I have a formula here for cash. It is last year's cash plus the change in cash. We're forecasting 0 for now. Accounts receivable, which is to make an assumption, that is 15% of sales. We talked about fixed asset at cost. That is going to be that 1.6 million of CapEx. We're going to add that to last year's balance. Accumulated depreciation. Here's we had to be a little creative and try to forecast this. I'm going to say that the accumulated depreciation has to be last year's. Last year, there's a further depreciation of $1 million, so let's just assume those assets continue to be depreciated at a rate of $1 million a year. But I'm going to take the new CapEx and divide by 10 because that's going to be depreciated straight line over 10 years. So that gives me 4.166 million, which then drives this number here, which is our depreciation expense for the year. Accounts payable, we'll assume that stays at 8% of sales. You could also do that as a percentage of cost of goods sold, but we're going to do sales. Our debt is going to be unchanged, last year's value plus the change in debt, which is 0. Our stock, last year's stock plus change in stock, is 0. Accumulated depreciation, again, that's the link from the balance income statement. There's our total equity, total liabilities and equity. Now notice here I have a formula here, which is the difference between total assets of 10.6 million and liabilities of 11.5 million, liabilities and equity of 11.5. So if this is positive, that means I need additional funding. If it's negative, which it is, that means there's excess funding. In other words, we have more financing than we have assets. So we've borrowed more money or raised more capital than we actually needed to buy assets. So we're going to take care of that in a few minutes. So here's our first pass at the financial statements. $1,000. Now, with this excess funds, since the assets are less than liabilities of equity, what we're going to wind up doing eventually is make some choices. You can either pay off some debt, so why not reduce our debt balances and reduce our interest expense? We could buy back stock. The stock is currently selling at $10, so we can buy back a number of shares. We could increase dividend payout, so we can pay a larger dividend, more than 40%, to use some of that excess funding. Or we can just let the cash balance jump up. You know, we can go from 800,000 to add an additional balance there. So those are our choices we're going to do. Now, if assets were greater than liabilities and equity, in other words, we needed to finance more assets, we would either issue more debt, issue more stock, decrease the dividend payout, or use cash. Let's talk about cash. Now, in finance, there's a saying that cash is king. In other words, profit is good, but cash is king. You can't spend profit. As you've learned in your accounting classes, that profit does not always mean cash. And if I was running a business, what I care about is how much cash I can put in my pocket. So we're going to measure a cash flow measure called free cash flows to the firm, FCFF. It's the cash flow available from a business after it meets its reinvestment needs, say capital expenditures and working capital. And it's cash flow available to meet its reinvestment needs, available to meet its debt obligations, and available to pay off shareholders either through a cash dividend or a stock repurchase. So let's calculate our free cash flows. So here we go. There's 3 methods to calculate this free cash flow to the firm. The first thing I want to do is from my financial statement, let me get my net non-cash working capital. So I'm going to take my accounts receivable, inventory, and subtract off my accounts payable. I'm going to call that non-cash working capital. And that increased from $700,000 to $770,000. So in other words, it was a $70,000 increase in non-cash working capital. We're going to use that in a minute. So the 3 ways to getting free cash flows to the firm, all of them get the exact same result. And the only difference is where you start. Do you want to start with EBIT, EBITDA, or net income, earnings after tax? I traditionally start with EBIT. So again, EBIT is earnings before interest and tax. So depreciation has already been subtracted. So what I'll do is I'll take my EBIT and I'll take out taxes by multiplying times 1 minus the tax rate. So if I take my EBIT from the income statement, my forecasted EBIT, times 1 minus the tax rate, you can think of it as after-tax EBIT, or sometimes it's called NOPAT, net operating profit after tax. All right, so the goal now is to convert from that measure to the measure of cash flow available to pay off our CapEx, to pay off our debt, or to maybe issue debt, and to deliver dividends. So here we go. We're going to start with our net operating profit after tax. The first thing we're going to do is add back depreciation. Remember, depreciation is a non-cash expense. It is really, it's a measure of how much, or the recognition of past purchases. So if you bought, in this case, our CapEx for this year is $1.16 million, we're going to depreciate $160,000 this year for that CapEx. However, that $1.6 million of CapEx is going to show up right here. Now the $160,000 is showing up right here, right? Because that's part of the change. So if I were to count both of those as expenses, I would be double counting my CapEx. So what we can do is we can add back the non-cash depreciation expense and then subtract out CapEx. Therefore, I'm not going to double count capital expenditures, right? Once when it happens and once when the accountants put it through the income statement. And then the last thing I want to do is I want to subtract any increase in working capital. This is going to cost the firm cash. If you have to increase inventories for whatever reason, that's going to create cash, or it's going to be a source of cash. Now, when you increase inventory, that's a balance sheet transaction. It's never going to hit the income statement. So that increase in inventory never made it to EBIT. That's why I have to account for it here. Likewise, any increase in accounts receivable. Now, accounts receivable would be a sale. Now, that sale would show up here in earnings before interest and tax. But if it's billed and the customer didn't pay, it's going to sit as an accounts receivable. So any increase in accounts receivable has to be adjusted to cash. And I'm going to add any increase in accounts receivable here. What it's doing, it's basically backing out from EBIT any sales that were not cash. Conversely, any increase in accounts payable will create cash. So the idea here is that in EBIT, there are cost of goods sold. But what if we never paid one of our vendors, one of our suppliers? Well, that's going to create some cash, right? The idea that the expense is here, it's pretending as if it was cash, but if we didn't pay it, we increased our accounts payable, that would actually create cash. So that net working capital, non-cash working capital, that change is going to show up as a source of cash. And now we have free cash flows to the firm of $2.028 million. So that is the cash that's available to now buy back some debt, buy back some stock. In other words, retire debt, buy back some stock, pay a bigger dividend, or maybe even increase our CapEx to increase sales later. Now, the other ways to calculate free cash flows of the firm, again, it doesn't matter which way you do it. It might be good to work through all of them because sometimes you have limited information to calculate this. Here's a one where we start with EBITDA, all right, not EBIT, EBITDA, and then we take the after-tax EBITDA by just taking EBITDA times 1 minus the tax rate. Now again, in EBITDA, earnings before interest, tax, depreciation, and amortization, there is no depreciation expense in this number. But remember, depreciation expense is a non-cash expense, so we really don't want to add it. We don't want to include it, which is good. However, when you have any kind of expense that flows through the income statement, you then can subtract. That is going to subtract from earnings before taxes. That is going to reduce our tax bill. So the only impact of depreciation is on the savings in tax. So if I take my depreciation of $1.16 million in year one, that is non-cash expense. However, 40% of that is $466,000. That depreciation expense is going to reduce our bill to the IRS. So the depreciation is not included in here. However, its tax effect, which is equal to the depreciation expense times the tax rate, is included. That's basically the tax savings from depreciation. And then we just also include our CapEx and our change in working capital, and notice we get the same value. And the last thing we can do is we can start from earnings after tax. This is our bottom line, our net income. So our bottom line, what we need to do is first add back depreciation expense, just like I did at the top one, right? That's the same thing going on. I'm going to subtract my CapEx, just like that one there. And I'm going to subtract out my change in working capital. So now it looks almost like the first method. The only change I now need to make is in net income. There's interest expense and there's interest income. We do not want to include that. This measure of free cash flow, one way of thinking about this FCFF, free cash flows to the firm, is a cash flow that's being generated from the operations of the firm before the payment of any capital back to shareholders or bondholders, and does not include investment activities like holding marketable securities. So what we're going to do is we're going to add back interest on debt the after-tax interest on debt, and we're going to subtract any after-cash interest on cash. And there's my free cash flow to the firm. Couple shortcuts sometimes people talk about. Sometimes instead of always taking, say, CapEx and depreciation, all right, let's erase some here. Notice I have CapEx and depreciation, right? CapEx and depreciation, CapEx and depreciation. Sometimes people will add these two numbers together and call it the net CapEx. So if I take CapEx minus depreciation expense is $500,000. One way of thinking about that is our CapEx was greater than our depreciation expense, so we are actually growing the asset base of the firm. We're increasing the number of assets, which you'd think would drive more sales. And then the last thing we can do, we can take that CapEx minus depreciation, which is the net CapEx expense, and subtract the change in working capital, that $70,000. So in other words, we could take all of those numbers, right? All of these numbers here, and just make one big number and call it the net reinvestment. So in this case, the firm had to reinvest $571,000 of their NOPAT. So if I take my EBIT times 1 minus tax rate, my NOPAT, I could have just subtracted 571, which would have been my free cash flow. So in other words, take your NOPAT minus your net reinvestment. That's one way of kind of getting a quick number. How much did I put back into the firm this year? All right, back to our forecasting. Again, what we did is we forecasted from last year's actuals with some value drivers, and we forecasted this year's net income. Let's talk about how that's done in the firm. You don't, as a financial manager, you don't do this in a vacuum. You're working with the entire firm. So in other words, where'd you get the revenue number? You worked with the marketing executives. Where'd you get cost of goods sold in SG&A? You worked with the manufacturing and ops. You work with supply chain, and you also work with, say, HR to figure out what raises are people going to get. Are we going to have changes in our benefits? Depreciation, interest, taxes, you're going to work really closely with accounting to make sure those are right. CapEx, you're going to work with probably supply chain people, engineering, and manufacturing to figure out what equipment they need to generate the sales and inventory and other items. Working capital, you're going to probably work closely with, say, marketing to figure out the accounts receivable. What are the accounts, what are the payment terms? And then you're going to work with supply chain to figure out how much inventory and payables they need. So as the financial manager, you're interfacing with the entire corporation to come up with this forecast. And again, we've done our first pass forecast. So what we have is no changes in cash, debt, and equity. So and the firm is generating, we said, $2 million in free cash flows. Now, you're going to work closely with the senior management of the firm and try to figure out, in this case, what would you like to do with that $2 million in cash? I could pay it all as a dividend. I could pay it all. I could use it to pay down debt. I could just add it to cash and get more interest in the future. So they've decided to make these financial decisions. They're going to pay down $800,000 in debt to reduce financial risk and interest expense. Right? The less debt you have, the more less fixed expenses you have, the less risk you'll go bankrupt. They're going to buy back $200,000 in shares. So shares are selling at $10 a share. They're going to go out and in the market and buy $200,000 worth of stock, or 20,000 shares. Now, why do shareholders like this? Well, one, by buying back shares, you're going to increase the fractional ownership of the remaining shareholders. Two, as a shareholder has a choice to participate in the buyback program. So they volunteer and say, yes, I would like to sell back my shares at $10. The benefit there is the shareholder will again get cash. That cash may be a long-term capital gain, which is taxed at a relatively low rate, and that would be beneficial to just maybe paying dividends. So the benefit of a buyback versus maybe paying a bigger dividend is with a buyback, the shareholder decides whether they'd like to get the cash. Also, they can avoid paying high taxes on dividends. And then lastly, after they buy back $800,000 of debt or pay down the debt, and they buy $200,000 worth of stock, they're going to adjust the cash balance. So if we have cash left over, we'll just let that increase cash. If it decreases the cash balance, the management said that's okay as long as cash does not fall under $200,000. So let's go ahead and do this. I'm going to go back to my start file that we've been working on. And we're going to put in those decisions. This first decision was to pay down $800,000 in debt. I'm going to put minus 800. Notice that's going to reduce the debt from 3.2 million. Whoops, put it in the wrong place. Sorry about that. Debt minus 800,000. That's going to reduce the debt balance from 3.2 million to 2.4. It's also going to reduce the interest expense. I'm going to buy back $200,000 in stock. What that's going to do is going to reduce the stock balance from 4.5 to 4.3. And also I have a calculation here that my shares are going to fall by 20,000 shares, which is 200,000 divided by $10 per share. We'll assume the stock price stays at $10. So now I have actually, looks like it's created an imbalance of $89,000. In other words, my assets and liabilities are now 10.6, and my liabilities and equity are 10.5. So I'm going to have to reduce the cash balance to get this to balance. Now I can do this the hard way. The hard way is, notice here's my additional funds needed. I just have a link down here. I could just reduce cash balance by 89,401. But notice it didn't work. It got close, but here's the problem. When I reduce cash balance by 89,000, it's not going to make that additional funds needed go to zero. Because what happens is I reduce my cash balance, I'm going to get less interest. When I get less interest, I'm going to have less retained earnings, which is going to reduce my liabilities and equity. So every time I reduce cash, I reduce retained earnings and equity. So you have to do this iterative process where I'm going to then subtract an extra 1287, which is the interest effect. But it's still not balanced because I reduced cash of 1,200 and I would have got interest on that. So I can subtract that another 19. And there we go. At reducing cash balance by $90,000, I'm able to balance the balance sheet. Now let me show you a tricky way to do that. I'm going to put in 0.01 here. It doesn't like when I have just 0 to do this process. See, I still have my additional funds needed of $89,000. I can use Excel's function here. Data, what if, goal seek, set additional funds needed to 0 by changing my cash balance, or my changing cash balance in this case. And it's going to do that iterative process and get there. So there we go, have it. We now have our financial statements. Do a quick financial ratio analysis. A couple of things I'm going to do is look at some ratios, but first I want to do a common size financial statement. So this is pretty busy, right? It would be hard to figure out, well, what really happened in the firm? I know sales and net income went up, but what really happened? Here's a common size financial statement. Take all of your assets, take all your income statement items and divide them by sales. Take all of your assets and divide by total assets. Take all of your liabilities and equities and divide by L&E. And then you immediately see what happened in the firm. Looks like depreciation expense went up. That's going to basically offset our sales increase. Interest on earned on debt decreased. That's from our debt repurchases, and we lost a little bit of interest on cash. So it's nice in that you can kind of really see what's going on here. On the asset side, you can see our cash as a percentage of total assets went up, and I have that big chunk of fixed asset coming in through CapEx. On the debt side, we paid down debt, and we decreased our stock with the repurchase, and we increased our retained earnings. So you can see a big switch from debt financing to equity financing. And then we can do some basic ratios: earnings per share, dividends per share, our dividend yield. We got some growth rates, the percent change in top line growth, revenue, percent change in bottom line growth, net income. We got our ROE, our ROA, operating profit margin, net profit margin, times interest earned, which is a measure of how much money you're generating to pay off your interest expense. Your current ratio is a measure of kind of short-term liquidity, ability to meet short-term liabilities. And then I just put in a price-earnings ratio. So in this topic, we designed financial models using appropriate styles and organization, forecasted an income statement, computed free cash flows, and did some basic financial statement analysis. The next topic is the time value of money. In that, we're going to forecast multiple years of cash flows and compute the fundamental value of this firm and its stock.